The market has been going up and down every other day. But rather than looking at the volatility and feeling scared, I've actually been buying a few stocks that I felt were great buys at the current prices. I don't want to waste any of your time, so here are the stocks that I'm buying right now: Google, Amazon, S&P Global, Nvidia, and AMD. If that's what you're here for, you can go watch other videos now. Or you can stick around to find out my bull thesis, bear thesis, as well as the fair value for each of the stocks. So with that being said, let's jump into the first stock, Google. Google is a fantastic business that has consistent growth, high profitability, and strong moats. But right now, Google is just trading at 21 PE ratio. This is due to uncertainties surrounding it, such as fears of Google losing its search dominance due to AI, as well as the Department of Justice wanting to break them up. Personally, I think the fears are overblown, since we have not seen Google's search revenue being impacted by AI in any meaningful way over the last few years. And the Department of Justice legal proceedings will typically take years, if not decades, to settle. This was what happened to Microsoft, and Microsoft eventually avoided getting broken up. So here's my bull thesis for Google. 1. Google's search business is still dominating and is not going anywhere soon. This gives Google strong pricing power and the ability to benefit from a secular increase in digital advertising spending. 2. Google Cloud is growing at a rather fast rate of 30%. Now, obviously, it won't grow that fast forever, but it does show that Google Cloud is becoming a bigger part of their business. Not to mention that Google has recently acquired Wiz, which can potentially help to strengthen their cloud's position in the cybersecurity market. Third, even though their other best revenue and growth looks very little now, their Waymo project has been coming out nicely. Right now, they are already offering 200,000 trips per week and will continue to expand their services to other countries. Eventually, the vision for Waymo is to start offering subscription services for its autonomous driving software, which can be deployed in large trucks and personal vehicles, which many of you may know is a high-margin business. Now, let's talk about the bear thesis. 1. Google's search revenue could eventually get disrupted by AI. Probably, we have not seen the full effects right now, but this could certainly happen in the future as AI gets more and more advanced. 2. Their advertising business is cyclical, so if recession comes, it may affect their earnings in the short term. So, what is the fair value for Google right now? Over the past 3 years, Google earnings per share was growing at 17.5% annually, and analysts are expecting Google's earnings per share to continue growing by 16% over the next 3 to 5 years. So, based on this assumption, Google's fair value right now would be around $189, which gives it an 11% margin of safety from current prices. But if you compare it against Morningstar fair value of $237 for the company, Google is now still super cheap. Besides stock valuation, some people may also want to use technical indicators to analyze stock prices, such as support and resistance levels, RSI, and moving averages. For this, the moomoo app offers automated technical analysis tools, such as the Market Position Overview feature on the Chart tab, which shows a stock price potential support and resistance levels. moomoo also provides more than 160 technical indicators and 50 drawing tools to help you better analyze stock prices, such as the automatic technical sentiment analysis, which allows you to see if the stock is bullish or bearish right now. Or if you would like to research more about the company, moomoo has extensive company data, such as valuation information, financial data, and more. For example, if you want to check out Google's valuation, you can use moomoo's company valuation feature to check what its current PE ratio is compared to the past 5 years. Not just that, it also has Wall Street analyst target prices and ratings with the analyst ratings feature, as well as detailed reasons for analyst ratings and their track records. Moomoo also offers Morningstar ratings, which is one of the sources that I often refer to. This is a paid feature, but it's available for free on moomoo. New users who sign up to moomoo Singapore will get to earn up to $820 worth of welcome rewards when you fulfill the terms and conditions. Plus, enjoy zero commission for US, Hong Kong, and Singapore stock trading, as well as zero commission trades on US options every month for up to 100 contracts. For more details of the promotions, do refer to the link promotion page in the description below. Moving on, Amazon. Amazon is an entire beast of its own. It has a diversified business model across e-commerce, cloud computing, advertising, and subscriptions, just to name a few. One of Amazon's biggest strengths has always been its ability to make investments that can deliver strong returns and drive long-term growth, whether it's by building data centers, warehouses, and most recently, AI. That's why you always see their free cash flow going up and down in cycles. So, what's the bull thesis? 1. They are the clear leader in both the e-commerce space and cloud computing space. And as the market share grows globally, Amazon is well positioned to benefit from this trend. 2. Both their advertising and AWS are high-margin businesses and continue to grow at a fast rate. This will help to boost profitability over the next few years. 3. They have very diversified revenue streams, from retail and subscriptions to advertising and groceries. This helps the company reduce reliance on any single business unit. As for its bear thesis, 1. As they grow larger, they may face increasing regulatory and compliance scrutiny. 2. Their incredible growth may not last forever and may eventually slow down due to market saturation. Additionally, the company may also face difficulties in penetrating into some countries due to inferior logistic networks. 3. Their retail and prime businesses are susceptible to economic downturns and shifts in consumer preferences. So, what's Amazon's fair value right now? Over the past 3 years, Amazon earnings per share has grown by a whopping 41% annually. But going forward, over the next 3 to 5 years, analysts are expecting the earnings per share growth rate to slow down to around 18 to 20%. So, using this assumption, this puts Amazon in the fair value territory at $177. But if you check Morningstar, they think this should be closer to $240, which should put Amazon in the undervalued territory right now. Next, I've also been buying S&P Global. S&P Global is a leading provider of financial data, analytics, ratings, and indices. In fact, this company is so deeply entrenched in the financial industry that they have become a critical part of the market infrastructure, with their insights and indices shaping key decisions made by investors, businesses, and even governments worldwide. So, for my bull thesis, 1. This company benefits from a diversified and recurring business model that provides stability and recurring revenue, as can be seen from their earnings. Not just that, all of S&P Global's business segments benefit from the secular growth in the global financial markets and the ever-increasing reliance on data-driven decision-making insights. 2. Their comprehensive suites of offerings are essential to the functioning of global markets. This puts the company in a dominant position with a strong moat and strong pricing power. As for its bear thesis, while the S&P Global benefits from its wide market reach, some of its businesses can still be influenced by broader economic cycles. For example, during a market downturn, they can see lower demand for some of the services, such as market-related data and indices segments. 2. The market intelligence segment, which makes up almost 1/3 of S&P Global's overall revenue, is facing increasing competition from other providers, such as FactSet, Refinitiv, Bloomberg, as well as from newer tech-driven companies offering AI-powered solutions and alternative data sources. This could put pressure on S&P Global's market share and pricing power, especially as customers increasingly demand more advanced, real-time, and customizable solutions. And what's the fair value? S&P Global's long-term free cash flow has been growing at around 21%. Meanwhile, analysts are expecting the company's free cash flow to continue growing around 16 to 20%. So if I just use an 18% growth rate estimate, this will put S&P Global fair value at around $488, which is actually pretty close to current price level. Though, according to Morningstar, the fair value should be closer to $540, which would mean it's undervalued right now. Next up, we have Nvidia. Nvidia is arguably the biggest beneficiary of this whole AI boom, as there's currently huge demand for its GPUs to power AI models and machine learning. So, what's the bull thesis? I think it's very clear that there's currently no company that can even come close to Nvidia's dominance when it comes to data center GPUs. In fact, Jensen Huang even said that Nvidia GPUs are so good that even when the competitors' chips are free, it's still not good enough. And as AI technologies continue to grow, Nvidia will continue to benefit from the increasing demand for its high-performance GPUs. 2. Nvidia isn't just only in the GPU making business. They are also moving into other business segments, such as networking, software, and services. This can help to further diversify its revenue streams and strengthen its position in the AI ecosystem. One such example is their auto segment, which even though it's just a small part of their overall business, has already seen quite good progress and is expected to become their next billion-dollar business. As for the bear thesis, Nvidia is currently the biggest player in the hottest industry right now. As such, it shouldn't come as a surprise that they are facing increasing competition both from their rivals such as AMD and Intel, as well as the customers such as Amazon, Meta, and Microsoft. So if the competitors could deliver similar or better performance at a lower cost, Nvidia could lose market shares, which could potentially affect its stock price. 2. Nvidia relies heavily on its semiconductor manufacturing partners like TSMC. So if ever there's disruptions in the supply chain, such as shortages of critical components or geopolitical tensions, it could negatively impact Nvidia's production and revenue growth. Third, the semiconductor industry is highly cyclical, where it can see periods of strong growth followed by downturns. So a downturn in the semiconductor market could hurt Nvidia's revenue and margins. So what's Nvidia's fair value right now? Nvidia's recent free cash flow growth rate was close to 97%, while analysts are expecting the growth to go down to 68% over the next few years. But I prefer to be more conservative here and just use a 25% growth rate instead. This will put Nvidia's fair value to around $107, which puts it quite close to Nvidia's current share price. And according to Morningstar, the fair value isn't too far off either, at around $130. Lastly, we have AMD, or what some people like to call a once money destroyer, after the stock has plunged by almost 50% from its peak. Looking at the share price right now, you would think that AMD is far gone. But if you check out their fundamentals, it's actually telling an entirely different story. That's because 1. The company has actually been able to continue growing its revenue. And if you look at the breakdown, this growth came from both the data center as well as client segments. And 2. AMD's balance sheet is still rather healthy, with its strong cash flow, a debt level that's manageable, and improving profitability. But perhaps more importantly, the company is now making moves in the AI and data center space, such as launching chips that could potentially rival Nvidia and acquiring both ZT Systems and Silo AI to help strengthen its AI and cloud computing capabilities. In fact, the CEO herself is so confident about the growth that she said that AMD's data center GPU revenue will grow from the $5 billion annual revenue currently to tens of billions of dollars in the coming years. Now, don't get me wrong, I don't think AMD will catch up to Nvidia. But in order for AMD to win, Nvidia doesn't have to lose, because the market is large enough. So here's my bull thesis for AMD. AMD is expanding in the AI chip space and can position itself as a strong alternative to Nvidia. Meanwhile, they are also slowly gaining market share in the consumer CPU market against Intel. As for the bear thesis, 1. With Nvidia's CUDA ecosystem, software mode, and deep AI partnerships, it can be difficult for AMD to gain any meaningful AI market share. 2. AMD is facing competition from Intel, which is also aggressively expanding in both the CPU and GPU space. 3. There could be macroeconomic risk, such as slowdowns in PC sales, data center spending, as well as semiconductor demand. So, what's the fair value for AMD right now? AMD's earnings per share grew at an annualized 35% over the past 5 years, and analysts are expecting EPS to continue growing at 29% over the next 3 to 5 years. But if I just want to be a little safe here, I can just assume AMD EPS will only grow at 20% over the next 10 years. This will actually put AMD's fair value to be around $104, which is close to the current share price. Meanwhile, if you check Morningstar, they think that the fair value should be closer to $140, which represents an upside of almost 30% from current levels. So those were the 5 stocks that I'm buying right now. Anyway, that's all for this video. Like, share, and subscribe, as I'll be posting every Monday, Wednesday, and Friday.